In the shadowed corridors of the global financial elite, a terrifyingly synchronized event took place between the early winter and late autumn of 2024, a phenomenon so vast in scale yet so clinically precise in its execution that it can only be described as the greatest capital exodus of the modern era. This signal, flashing red for those who know where to look, heralds a catastrophe that is rapidly approaching the unsuspecting retail market. While the mainstream media and financial news networks were busy distracting the public with headlines about a soft landing and the endless potential of the artificial intelligence boom, the individuals who actually own the world, the architects of the global economy, we are not talking about standard portfolio rebalancing, nor are we witnessing the benign shuffling of assets for tax purposes. This is a fire alarm ringing at a frequency that only the ultra-wealthy can hear, and their response has been to sell, sell, and sell again. The roster of sellers reads like a list of the most informed individuals on the planet. Jeff Bezos, the man who built the logistical spine of the Western world, unloaded a staggering $13 billion of Amazon stock, a move that starkly contrasts with his behavior during previous market peaks. Mark Zuckerberg, riding the wave of Meta's resurgence, cashed out over $9 billion. To understand the gravity of this situation, you must realize that these men do not panic. They do not act on emotion, and they do not guess. They operate with an information advantage that is effectively insurmountable for the average investor. They possess real-time access to the raw data of the global economy, credit card default rates, shipping volumes, cloud computing expenditures, and commercial loan performance, months before that data is sanitized, packaged, and released to the public in government reports. When Jamie Dimon, the data tracking this exodus is irrefutable and alarming. According to the Washington service, which has monitored insider transactions for half a century, the ratio of insider selling to insider buying, a metric that typically hovers around a healthy 2.1 or 3.1, skyrocketed in 2024 to a chaotic 9.1 average for the year. In specific months, we witnessed a spike to 12.1, meaning that for every single dollar insiders spent showing confidence in their own companies, they were pulling $12 out. This is a level of disparity that has only been seen once before in history, right before the global financial system nearly collapsed in 2007. The public explanations for this selling, estate planning, tax optimization, philanthropy, are merely convenient smokescreens designed to placate the masses while the smart money secures its lifeboats. After all, Bezos and Zuckerberg have had decades to diversify, yet they chose the precise moment when the Buffett Indicator hit 185% and the Shiller P/E ratio climbed to 34 to execute their largest sales in history. This brings us to the 5 undeniable historical patterns that prove this is not a coincidence, but a precursor to a crash. First, the pattern of timing, which shows that insiders historically liquidate 12 to 24 months before the actual market top, just as they did in early 1987 before Black Monday and throughout 2007 before the housing bubble burst. Second, the pattern of the ratio itself, where a sustained sell-to-buy ratio above 8.1 has a 100% success rate in predicting a market crash within 2 years. Third, the pattern of sector-specific selling, where insiders in the most overvalued bubbles, in this case tech and financials, rush to the exits first, mirroring the tech insider selling of 1999 and the bank executive selling of 2006. Fourth is the diamond hands capitulation, where the selling by long-term holders like Dimon and the Waltons signals a generational top. These are the investors who have held through wars, pandemics, and recessions, and their decision to sell now means they believe the risk-reward profile of the market has fundamentally broken. Fifth and finally is the sheer volume threshold, which indicates that whenever total insider selling exceeds $400 billion in a single year, a number we smashed in 2024 with $464 billion in total sales, the market invariably fails to make new highs for a period of 3 to 5 years following the peak. But what exactly are these billionaires seeing that makes them so bearish? They are looking at a dashboard of macroeconomic indicators that are flashing red. First, they see the Buffett Indicator, total stock market capitalization divided by GDP, sitting at an unprecedented 185%, implying that the stock market is valued at nearly double the entire economic output of the United States. This is a disconnect that can only be resolved by a massive 40–50% correction in asset prices. Second, they are staring at a Shiller PE ratio of 34, a level of overvaluation that has only been reached 3 times in the last century. In 1929 before the Great Depression, in 2000 before the third, they see the towering edifice of margin debt, which reached $950 billion in late 2024, creating a highly leveraged system where even a small decline in asset prices will trigger a cascade of margin calls, forced liquidations, and selling begetting more selling, a feedback loop that accelerates crashes from corrections into catastrophes. Fourth, and perhaps most terrifying to the banking elite like Dimon, is the slow-motion implosion of the commercial real estate sector. Office buildings across major cities sit 40–50% vacant due to the permanent shift to remote work, turning trillion-dollar assets into liabilities that are now worth 40% less than they were. Fifth, they see the corporate debt refinancing wall, a looming crisis where $4.7 trillion in corporate bonds are set to mature between 2024 and 2026. These companies, which gorged themselves on cheap debt at 2% interest during the easy money era, must now refinance at 7% or 8%. This is a mathematical impossibility for zombie companies that barely turn a profit, guaranteeing a wave of corporate bankruptcies, layoffs, and defaults that will ripple through the economy. Sixth, the federal debt spiral has reached a point of no return, with the U.S. national debt crossing $36 trillion and interest payments alone consuming $1.2 trillion annually, more than the seventh, and finally, they are reacting to their own internal proprietary data. Bezos sees Amazon's unit sales slowing as the consumer taps out. Zuckerberg sees ad revenue growth hitting a wall, and Dimon sees credit card charge-offs rising to levels that indicate the American consumer is completely broke. When you combine these 7 data points with the 5 historical patterns of insider selling, the timeline for the coming crash becomes horrifyingly clear. Historical analysis shows a lag time of 6 to 18 months between peak insider selling and the onset of the crash. Given that the selling peaked in the middle quarters of 2024, the mathematical window for the collapse opens in Q3 of 2025 and extends through Q2 of 2026. This period also, the crash, when it comes, will likely be triggered by a black swan event, a bank failure, a geopolitical shock, or a sudden credit freeze. But the trigger is irrelevant. The fuel is already stacked, and the insiders have already left the building. The consequences of this crash will be a brutal bifurcation of society, a wealth transfer mechanism that punishes the unprepared and rewards the liquid. The winners will be the very billionaires who sold you their stock at the top. Bezos, Zuckerberg, and Dimon are sitting on billions in cash, waiting for the market to fall 50% so they can re-enter and buy back their own companies at half price. The winners will also be the prudent few who held gold, which acts as the ultimate insurance policy against the monetary printing that the Federal Reserve will inevitably unleash to try and save the system, just as gold doubled in value following the 2008 crisis. The short sellers, those daring enough to bet against the bubble, stand to make fortunes, though the risk of mistiming the drop makes this a dangerous game for the uninitiated. On the losing side will be the middle class, the retirees, and the passive investors who trusted the buy and hold mantra blindly. Their 401ks, heavily weighted in equities, will be decimated. The tragedy is that this is not an accident. It is a cycle, a recurring feature of the financial system that transfers wealth from the many to the few, from the reactive to the proactive. But you do not have to be a victim. While you cannot stop the crash, you can position yourself to survive it by following the lead of the insiders rather than their words. The action plan is clear and urgent. First, reduce your equity exposure immediately. If you are 80% or 90% invested in stocks, you are sitting on a ticking time bomb, and you should consider trimming that exposure to 40% or 50% to preserve capital. Second, raise cash. Cash is not trash during a deflationary crash. It is king, granting you the optionality to buy high-quality assets when they are on sale. Second, Allocate a meaningful percentage of your portfolio, 10% to 20%, into gold or gold equivalents, as this will protect your purchasing power when the central banks eventually pivot to hyperinflationary tactics to bail out the sovereign debt crisis. Third, build your buy list now. Identify the fortress companies with strong balance sheets, the Microsofts, the Costcos, the Visas, and prepare to buy them only when they have fallen 40% or 50% from their highs, mirroring the strategy of the billionaires. Fourth, finally, protect your income stream. Build an emergency fund of 12 months' expenses because the coming recession will bring unemployment, and you do not want to be forced to sell your assets at the bottom just to pay the mortgage. The signs are everywhere for those willing to look. The $50 billion insider exodus, the 12.1 sell-to-buy ratio, the 185% Buffett Indicator, the vacancy signs on office buildings, and the unprecedented selling by long-term holders like Jamie Dimon.